traders, and welcome back to another episode of Forex here. Today, we are delving into a subject that truly distinguishes successful traders from the rest: the art of identifying ideal trade setups. Recognizing those lucrative trading opportunities with a high probability of success requires time, experience, and a discerning eye. Trading without a clear understanding of what you're searching for can lead to costly mistakes, resulting in a string of losses. In this episode, we will dissect the crucial factors and guidelines for pinpointing optimal trade setups using the concept of smart money. Furthermore, we will explore specific trading scenarios that provide smart money concept traders with a distinct advantage, putting you one step ahead of the market. So stick around until the end for valuable insights and strategies to elevate your trading game. Traders, if this is something that piques your interest, please show your support by giving this video a thumbs up and subscribing to our channel if you're new here. See you after the introduction. Welcome back, traders. Let's dive right in. To identify optimal trade setups with a high probability of success, there are three essential criteria we need to examine in the market. The first and most crucial factor we should always consider is liquidity. Indeed, the market constantly seeks to absorb liquidity to generate momentum. Liquidity essentially acts as the lifeblood of the market, playing a vital role in its overall dynamics and functioning. We can categorize liquidity into two separate types, static and dynamic. Let's briefly explain each of them. Static liquidity refers to specific zones in the market, where a large pool of money is resting, such as stop-loss orders and buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. It is often speculated that central banks and large financial institutions may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. To survive and thrive as a profitable trader, it is crucial to identify static liquidity on the chart. These areas where significant volumes of orders are present can provide insights into market dynamics and help prevent substantial losses. Liquidity can be identified in various areas on the price chart. 1. Below equal lows and swing lows. 2. Above equal highs and swing highs. 3. Along dynamic trend lines and channels. 4. Within order blocks. 5. At support and resistance levels. 6. Using Fibonacci retracement levels. 7. By analyzing daily candle bodies and shadows. It's crucial to spot a liquidity sweep pattern that occurs before the price reaches our point of interest. This pattern indicates the absorption of liquidity and provides an opportunity to confirm the strength of our identified supply or demand area. We use liquidity sweeps as a confluence factor before entering a position. The underlying theory is that the market requires liquidity to sustain its movement. If the price fails to sweep liquidity before reaching a point of interest, there is a high probability that the price will utilize that zone as liquidity to fuel its momentum. As mentioned earlier, the second type of liquidity is dynamic liquidity. Dynamic liquidity refers to the factors that determine the direction and movement of the market. In other words, it encompasses the elements that drive market movements. The dynamics behind market movements can be distilled into two key factors that consistently influence price direction: internal and external factors. Price in the market always moves between two types of liquidity: internal and external. Think of it as a continuous circle, where price moves either from internal to external liquidity or from external to internal liquidity. We have extensively discussed liquidity-related topics in our previous videos, and you can find the links to those videos in the description below. If you haven't watched them yet, I highly recommend checking them out to gain a deeper understanding of liquidity in the Forex market. Once we have a solid grasp of liquidity dynamics, our focus shifts to the second confluence factor: market structure. We analyze where the price is likely to move and gain an understanding of the dominant direction. This involves identifying whether the price is in a downtrend or an uptrend. To do this, we begin by analyzing market sentiment on a higher time frame, such as the 4-hour or 1-hour time frame. Our goal is to identify both the mitigated and unmitigated supply and demand zones, those located behind and in front of the current price. This analysis ultimately allows us to determine which side, whether it's the supply or demand side, currently controls the market. This is a crucial point that needs careful consideration because it helps us identify high probability points of interest and valid reversal patterns. This approach prevents us from falling into traps caused by false reversal signals, changes in market character, and trading in the wrong direction. For example, let's consider a bearish market structure where sellers are in control. Price has formed a series of bearish break structures and supply zones associated with these structure breaks. In the following scenario, we observe that the price moved upward after showing a slight rejection from the last supply zone, and it broke and closed above that zone. Here we encounter a common situation that often occurs in the market. Many novice traders who haven't correctly identified the market structure often view this upward movement as a change of character, a signal of a reversal in market direction. They believe that the bearish phase has ended, and that it's an ideal time to go long with a newly formed demand zone. They typically place their stop loss just below this new demand zone. However, contrary to their expectations, the price made a brief upward move, mitigated the upper supply zone, and then continued its bearish movement. This resulted in triggering the stop-loss orders of traders who had taken long positions. They often fail to understand why their stop-loss was triggered by the price and unfortunately repeat these actions. What they missed here is a crucial point. The price didn't reverse from any unmitigated demand zone. They shouldn't have entered a long position until the price reached a major unmitigated demand area. Their identified change of character was invalid, and the price only moved upward to mitigate the upper supply zone. It used the last supply zone as an inducement zone to sweep more liquidity and gain more momentum to fuel its downward movement. Are you ready to embark on an exciting journey into the world of online trading? Look no further than hankotrade, your trusted partner for a seamless trading experience. Discover the power of hankotrade and take advantage of our exclusive offer, a 100% deposit bonus when you sign up today. That's right, we're doubling your investment right from the start, giving you the edge you need in the financial markets. But that's not all. With hankotrade, you'll have access to a user-friendly platform, cutting-edge trading tools, and a wide range of assets to choose from. Whether you're a seasoned trader or just starting, our platform caters to all levels of expertise. Don't miss out on this incredible opportunity to boost your trading potential. Click the link in the description to register now and claim your 100% deposit bonus. Join the hankotrade community and start your journey towards financial success today. Now let's delve into the next confluence criteria, the time of day and week. When dealing with higher time frames such as 4-hour or 1-hour charts, it's essential to consider how close you are to the weekend. Additionally, take into account the time of day and the trading sessions. It's advisable to avoid trading during the final hour of the trading day, especially on Fridays. During this time, liquidity tends to dry up and spreads can widen, introducing higher risks into your trades. Imagine you've identified a flawless and perfect trading setup, one that aligns perfectly with your trading plan and offers an exceptionally high probability of success. The price is on the brink of reaching your highlighted point of interest, and you've set an appropriately small stop loss, creating an ideal trade opportunity. However, here's the twist. The market is lacking the necessary momentum and liquidity. This might happen during the last hours of Friday, the Asian session, or in the late hours, such as around 12 p.m. or 5 a.m. In such cases, the likelihood of this trade becoming a winner is rather low. To trade successfully at the right times, you need to understand how the market behaves during different parts of the day. So, we've now thoroughly covered the confluences and criteria that we need to consider to identify optimum trade setups with a high probability of success. Now, let's explore the ideal trading scenarios based on the smart money concept. In this first optimal trading scenario, let's imagine that we are trading at the perfect time of the day when the market has sufficient momentum and volatility. We've also thoroughly assessed the market structure and identified the directional bias of the price. All these factors align to indicate a potential selling opportunity. In this scenario, the price is in a downtrend and sellers are dominating the market. The price has recently broken out of a low to the downside, leaving a significant inefficiency in its wake. Consequently, a newly generated supply zone has emerged on the extreme, resulting from the recent bearish break of structure. It's crucial that this point of interest remains unmitigated. After the initial downward movement, the price retraced back up, forming equal highs just below our extreme point of interest. At this level, a substantial liquidity pool has been established. It's important to note that the existence of a liquidity pool near the point of interest is essential for validating the setup. Before entering the trade, it becomes crucial to identify a liquidity sweep pattern. Occurring just before the price reaches the point of interest, the presence of a liquidity pool beneath our identified supply zone significantly increases the probability of a potential price reversal from this zone. Traders who have placed their buy orders and stop losses within this liquidity pool are essentially providing a potential fuel source for the market's downward momentum. As mentioned earlier, we use liquidity sweeps as a confluence factor before entering a position. The core mindset behind that is if the price fails to sweep liquidity before reaching a point of interest, there is a high probability that the price will utilize that zone as liquidity to fuel its momentum. With size after forming equal highs, the price experienced a downward push, breaking the recent low and establishing a break of structure. It's important to note a key aspect here. We don't necessarily require the price to mitigate a demand zone and then start moving to the upside. This step is not obligatory because predicting when and where the price will reverse is inherently uncertain. In this scenario, what we anticipate is for the price to move upward, sweeping the liquidity accumulated above the equal lows, then entering the identified point of interest, mitigating it, and subsequently reversing to the downside, sustaining its downward movement. This optimal trading setup presents an opportunity to enter the market from our identified point of interest. Utilizing various entry models based on the smart money concepts covered in detail in previous episodes. As you analyze the charts, this setup represents one of the primary types of trading opportunities you should be on the lookout for. Now, let's examine an example of this trading scenario. Here, we have the 1-hour time frame of the euro-dollar pair displayed. It's evident that the price is in a downtrend and supplies are in control. If we shift our attention to the top of the chart, we can see that the price has broken out of this structure with significant inefficiency and momentum. It has also generated an unmitigated and fresh supply zone at the extreme. Subsequently, after a temporary retracement, the price began to move downward, resulting in a bearish break of structure and the formation of another supply zone. However, in the subsequent movements, we can see that the price retraced back toward the last supply zone and created perfect liquidity with the formation of equal highs in that area. The presence of this liquidity pool below our identified supply zones increases the probability of a potential price reversal from our identified extreme supply zone. As you can see, the price rose back up and utilized the last supply zone as an inducement area. It also swept the liquidity above the equal highs. So, we have the desired confluence that we were seeking in our analysis. Now the only thing left to do is wait for the price to enter the extreme supply zone, at which point we can set up an entry based on the various entry models explained in our previous episodes, following the smart money concepts. For example, we could employ the aggressive entry model by placing a sell limit order at the lowest point of the supply area. Alternatively, we can opt for a more conservative approach by seeking additional confirmation, such as waiting for the price to form multiple reversal patterns like a change of character in the current or lower time frames. Ultimately, we would set our entries at the lower time frames to achieve a better reward-to-risk ratio, thanks to the tighter stop loss. This was the perfect example of the optimum trading setups that I'm always looking for to enter a position in the market. The same concept applies to the bullish scenario. Now, let's delve into the next trading scenario. In this second optimum trading scenario displayed on the screen, let's imagine we have a structure like the one shown. In this downtrend scenario where the price has created bearish breaks of structures, what I look for is the price, after breaking and closing a structure and forming a supply zone, retracing back up. It taps into the recently created point of interest, experiences a reversal, and then starts to move downside, leaving a significant inefficiency behind and initiating another break of structure. This confirms that supplies have control and we are still in a downtrend. In the next step, we are seeking a consolidation phase, such as equal lows. We need the price to form sell-side liquidity, right at the bottom. If we take a close look at the left side, we can see that the price has already swept the external liquidity. Now it's time for the price to target internal liquidity, as indicated by this fair value gap that was generated right after the first mitigation. In the following steps, what we want to see is the price pushing upward, filling the liquidity void that was left earlier, and then entering into this unmitigated and fresh supply zone. Our next step is to zoom into the lower time frame and search for any signs of a change of character or reversal confirmation patterns. This allows us to set an optimum entry. Let's now examine a real chart example to illustrate this concept. Here, we have a 1-hour pound-yen chart displayed on the screen. As you can see, the price's general direction is bearish, and it has formed a series of downward breaking structures. The price has cleared the liquidity above these equal highs. After mitigating this demand zone, it reversed its direction and moved downward with momentum, leaving a significant inefficiency behind. Upon closer examination, this price action corresponds to our first optimum trading scenario. A liquidity pool was created just below the unmitigated supply zone. Subsequently, the price moved upward, cleared the liquidity accumulated above the equal highs, and then reversed from the upper supply zone. So this would have been my first entry if I were monitoring this currency pair. Next, we can see that the price moved downward, leaving a significant inefficiency behind. The price then retraced upward but didn't reach the upper fresh supply zone. Instead, it moved downward again, confirming that supplies are controlling the market. Additionally, the price created a perfect sell-side liquidity pool below the equal lows. Subsequently, the price moved upward to fill the internal liquidity left behind after a clear mitigation over the fresh supply zone. The price changed its direction to the downside, and we could have entered a short position here after detecting a change of character pattern in a lower time frame analysis. This real chart example demonstrates how these concepts can be applied in actual trading scenarios. Let's delve into the details of the third optimum trading scenario. Consider a bearish structure like the one presented in this scenario where we want to see several key events. 1. The price must reverse from a higher time frame supply zone, for example, a 4-hour point of interest. 2. Next, we look for the creation of a large order block identified by a candle with a large body. 3. Subsequently, we anticipate the price to move downward, confirming that supplies are controlling the market. 4. After forming a lower low indicating sell-side liquidity, the price retraces upward to fill the gaps left behind and mitigate the order block at the extreme. Notice that the price changes its direction towards the upper large order block during its temporary bullish movement to the upside, resulting in the creation of bullish order blocks. 5. Now what we want to see is that the price enters the zone of the large order block and experiences a reversal without mitigating the majority of the order block. In this scenario, it's crucial to notice the voids left inside the candle that require mitigation. 6. Subsequently, the price moves downward, forming an internal high that indicates buy-side liquidity. 7. Moving forward, it's essential to closely monitor the price behavior as it approaches the bullish order block. We need the price to reverse from the bullish order block. Start moving upward, utilize the last supply zone as an inducement, trigger the stop loss of traders who entered a short position from the last demand zone, and sweep the buy-side liquidity accumulated above the internal high. 8. Eventually, it should tap into the large order block, and after acceptable mitigation, the price gets reversed, moving straight back down towards the sell-side liquidity located at the bottom. To take advantage of this scenario, as the price taps into the large order block, we should zoom into the lower time frame and look for any signs of a change of character formed by the price. Then we are permitted to place a short position. Now let's proceed to the price chart and see an example of it. Here, we have the euro-dollar 1-hour time frame on the chart. Initially, the price moved upward until it reached the 4-hour time frame supply zone, reacted to it, and then reversed its direction. Subsequently, the price created a change of character by breaking and closing below the structure. Then the price moved upward to mitigate the order block generated by the change of character wave. As the price continued its downward direction, it created another break of structure and also formed this unmitigated large bearish order block. In the subsequent price action, we see that the price moved downward, leaving a significant inefficiency. It continued this downward momentum, breaking through multiple structures, confirming a shift in its direction with supplies now in control of the market, until it reached this low point where it faced resistance, reversed and established equal lows, forming a notable sell-side liquidity. Later on, the price reversed its direction, pushing upward. Although it mitigated the order block, it couldn't fully mitigate the majority of it. Following this, there was a temporary downward movement. After mitigating this bullish order block, the price reversed and moved upward, utilizing the last supply zone as an inducement. This move hit the stop loss of traders who had entered short positions from that zone. Price ultimately mitigated the large order block at the extreme once again. Following this, a substantial reversal occurred, with the price strongly moving downward and gaining significant momentum toward the sell-side liquidity. This trading scenario offers essential advantages, including a more refined point of interest, a safer entry point with a high win rate, and a high reward-to-risk ratio. Additionally, it provides the most suitable time to enter the market by filtering out risky entries. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.